Well, Edison, I always enjoy sitting down with you and covering a lot of different topics. And right now, here we are, a little halfway through June, and markets. Some of the market indices are starting to touch into what everyone's referring to as a bear market. I thought we'd just start there. Maybe what's a bear market? What makes a bear market?
Yeah. Always great to be here, David, doing this. So bear market is just a decline in aggregate index values, rather, from peak to trough by 20% or more, right? So once we dip in that negative 20% from the latest highs, technically that's called a bear market. Um, it tends to have a lot more media attention, so to speak, right?
Sure.
It's a whole number. It's a notable drop. I don't want to downplay the actual drop. Yet, I think the media can often get caught up in the meaning behind that bear market in a way that can often be too muddy or maybe not accurate enough. And I think it's important to recognize that and expand on it.
Yeah. So where are we then? And then that's the other part too. There's a lot of indices, and typically investors will grab a hold of whichever one works for them for that conversation,
Right.
right? If markets are going up, they always want to grab a hold of the highest indice and question, why am I not achieving the highest one? If markets are going down, they want to know where they are relative to maybe the lowest indice or the best performing, or the cleanest shirt in the dirty clothes basket,
Right.
right? Maybe
Right.
what's down the least, but we know that there are pretty solid broad indices.
Yeah.
Which three indices particularly do we monitor the most, and how are those doing?
Absolutely. So I think one of the main approaches we like to take is we do focus on that global diversification concept, right? And diversification, David, by definition, is notably that average return over time, right? How do you mitigate the massive swings to the upside and the downside while kind of sustaining that long-term trend?
Mm-hmm.
So as an example of that, the FTSE All World Equity Index is an example. About a 60 to 70% US exposure, the rest is international. We do tend to focus in that realm because even though we invest in each segment of the US equity market and internationally, that aggregate blend is where most clients do tend to fit in over the long term. Because I know we're talking about a bear market right now. The reality is 9 months from now, you're going to be thinking, what bear market? Because that's often how these cycles work, is just we tend to get caught up in that short-term nature of it, which is perfectly normal. I get it. But over the long term, it often is significant.
Sure. And how's the FTSE doing? I mean, how's the global market versus maybe a more common household name is the S&P 500 index, for
Right.
example. I mean, compare and contrast those.
Yeah, so the S&P 500 through here mid-June timeframe is down about 22-23% from its peak to trough, right?
Yeah.
Technically in a bear market. International markets are doing slightly better than that, not by much. The global portfolio, as an example, would be down from a benchmark basis around that 20% mark. Part of that is because some international assets, especially when taking the dollar into context, but we won't get into that today, have performed better,
Sure.
which has been a function of monetary policy a lot this year.
Sure. And then, so then again, we're talking about this. The focus is on these indices. Now, of course, we monitor our client accounts daily, regardless of how many households we serve and where they are in the United States. And I know with that, since this video will, hit YouTube, we won't get into specifics, but generalities, clients doing better or worse in these indices so far this year?
Yeah, so coming into the year, we made some really strategic decisions in where we wanted to be invested in the US markets and internationally, right? I'll get technical with you for 10 seconds, then you can stop me, right?
Sure.
Value stocks over growth stocks, currency hedged international exposure versus non-currency hedged. All those small decisions we made coming into the year have led to a notably better relative performance profile, net of fees for us for the year. What I love about this, right, is it doesn't mean that we're not going to experience downside. That's inevitable, right? The downside we do experience is often less. And now, my favorite part, reshuffling it all around and buying up some really beat up assets,
right,
for the next 12 to 18 months.
Well, and talk about flex. I mean, that's something else
Yeah.
too. I know that the firm put into place at the beginning of the year as well.
Yeah. So flex is kind of our assessment of market risk. And all it means is we're going to take a portion of your equity market participation and take it out of the market for a period of 3, 4, 5, 6 months, right? Now we curtail that at about 10%. And the reason we do that is because nobody knows to a definitive T what is going to happen in the markets. But being data driven, we can gain a pretty generally good idea.
Right. So when you guys, in your team and our firm, when we made that decision back in the beginning of January to take some equities off the table, put them in the short-term treasuries.
Yeah.
At that point, we don't consider ourselves pundits, right? We weren't making market calls. We weren't making economic recession calls.
Nope.
But even though we don't make those calls, again,
Yeah.
just want to have you repeat that. How does that process work, and why do it?
The reality is, when we make decisions like that, which are very math and quantitative driven, our goal is if we capture slightly less downside when there's volatility, David, we don't have to be as aggressive on the upside to be better off.
Right.
If you lose less, you can make up less and still be better off than accepting the entire volatility profile. And when we employ that process over different market cycles, right? Most recently, March of 2020. Now here we are in June of 2022. These cycles do repeat themselves over 3-4 year cycles. And if we can employ that flex technique 3-4 times over that 3 years, we have generated a measurable value add above that benchmark over time.
So where are we with Flex year to date then? Still sit on the sidelines, Edison, or is it starting to buy?
We have turned off Flex, David. When stocks tend to enter a bear market and we are doing better than a bear market on a relative basis, I'm like a kid in a candy store at that point, because I tend to not focus on the next 3 weeks or 4 weeks. The notion is, how do things look 12 to 18 months from now? And can we take advantage of this opportunity we have? The answer is yes, absolutely. So we have turned Flex off. We are back in the market fully, and we are looking at it daily.
Yeah, and what I love about this conversation is it's really getting into how we do what we do, because when we think about our objectives, of course, we want our clients to be able to achieve benchmark returns net of all costs of investing. So it's all internal fees, exposed fees, you name it. Our objective is to really help our clients achieve those returns net of all fees and costs. We do have our compliant reports that clients and non-clients can call into the firm and receive to get actual client performance going back over the last 9 years to see the actual results of our process and how it has worked.
Right.
And this conversation is here we are in this phenomenal opportunity to really add value to our clients. And hopefully this conversation is helpful so they can really experience during these moments, this is where the magic happens. And again, I go back to even like the Flex conversation. I think every investor in their heart and in their mind understands the concept of sell high, buy low. But if we left it for them to make that decision, I don't know how many of our clients would have been selling in January and buying here at where the market's at today.
The one of the things retail investors don't like to do is buy stocks when they're cheap.
Right.
It's just it's a counterintuitive wisdom. Whereas, if your favorite car went on sale by 20% tomorrow, you'd be like, I might buy 2 of them. I don't know. That is actually a psychological bias that we're all prone to.
Mm-hmm.
Just being able to recognize it and kind of shove it away, thinking of that long term, really helps.
Well, this is good. So just to kind of wrap it up, hopefully it answers some of the questions that we get during market volatility times. A lot of times those questions are around, am I okay? Are you watching my money? Are you taking any action? Because again, investors hate to be told just write it out. And and we agree. We think the terminology of write it out is actually really bad advice. The best advice is to stay true to the discipline of the process. Now, if they're not clients of Credent, and the process is to just buy something and sit there and write it out, I would argue that it's a bad process. And so make sure you get into a process that is proactive, takes advantage, and then stay true and disciplined to that process. So it's not about writing it out; it's about making sure that the money is being managed and stewarded in a way that fits the needs of that household.
Absolutely.